And this whole world of investing has totally changed from the mid-1980s on into where we are now. My father, I always say, now I wish my father could have been alive to see what is transpiring, how it is, how it's totally different. And it moves at the speed of a light, literally. You and I have to figure out how can we make money for ourselves. You know, the future, well, the past is not necessarily any representation of what's going to happen in the future. There are three directions of an investment's value. One is up, one is down, one is sideways. That seems very simple, right? My statement is you can make money in one of these directions. Do you believe that?
Yes.
If the market goes up, you can make money? Right? If the market goes down, can you make money? If the market's sideways, can you make money? If you owned 1,000 shares of IBM, and IBM was just sitting there at, I'm going to make the figure up because I don't really know what IBM is, 132 or 140, somewhere in there, and you sold calls on IBM and took that revenue in. If it stayed at 140, right, I'm not going to go into calls unless you want to, but we can get very intricate. The point is, by doing covered calls, or what they call buy rights, you could have your security stay at the same price, and you could be making money, and you could be making the dividend as well. So you take the dividend, you put it together with the call, and depending upon the period of time, you could write it 2, 3, 4 times a year and bring the income in. Okay, so let's talk about what different investments are. What's stock? Who knows?
Ownership of the company.
Right? So what are you buying? You're buying ownership in a company. What should your price be based on? When you're buying a share of stock, what determines the price? Now, the market determines the price. The market determines the price if you have somebody who's giving a bid, somebody who's giving an ask, and so the market is. But how do they determine how much they want to bid and how much they want to ask? Company A does $1 billion a year, has no debt, and earns 10%. Company B does $1 billion a year, is 45% in debt, and earns 15%. Company C has 15 to 20% in debt, earns about 15% and pays a 3% dividend. Which one would you want to buy? The question is, are they going to earn money, enough money? They don't have to. They could lose money. You know, there are two kinds. There's common and there's preferred. And if you own common stock, you're not first online would the company go under. Anybody who's a preferred shareholder would be paid first should the company go under, and you should know that. Preferreds are convertible and so on. But I can't go through every kind of investment this way, but I want you to know that, you know, when you look at companies, unfortunately, we tend to just look in the paper and pick up AT&T or whatever it might be, Apple or whatever. Very few of us really look at other ways to invest in these. But this is ownership. Bonds. What are bonds? This is very broad. If stocks are ownership, what are bonds?
You're loaning the company money.
Right. Right. And by the way, let me go back to stock. Companies incorporated, it has not got a finite life. The term of incorporation is forever. as long as the company is sound or not sold or whatever. But with bonds, it's a finite life, 10 years, 20 years, 30 years. So when it's issued for that period of time. And you know. So your risk, which I haven't used that word yet, but your risk is that the company is going to go out of business. Within the 30 years you loan them the money. Or they're not going to have the ability to pay the interest. And when the bond matures, they won't have the ability to pay you back. Now, it doesn't have to be a company. The instrument of debt is for a defined time limit. The ability of the underlying could be corporation, could be government, it could be state, federal, municipal. When the broker comes to you and says, you have $100,000 sitting in your account, wouldn't that be great? Right? And I can get you, $100,000 worth of bonds, and $100,000 worth of bonds is a general obligation to the state, and they give you a rate, and they say it's paying 9%. What would you do right now if they said that? Would you grab those bonds? And now, you'd look at the price, and you'd have to see what the price is, and you find that bond might have been paying 4%. The reason you're getting 9% is because you're not getting a par bond. You're getting the bond, and it's way down in price, so the interest you're getting. All right, now I'm just throwing it out there because you got to think. You got to look. You got to look under the covers, like I said before, because if it's too good, it's no good. Yeah. Options. Anybody trade options? Use options? Okay. Did I talk about options before?
No.
I remember I said
covered costs.
I said options. Okay. I said you can make money going up, going down, and going sideways. Now options are puts and calls. Calls mean you call the stock away from me. Very simple. Puts mean I put the stock to you. I'm not going to go through this. You're already swimming. My point is, it's risky. There is risk. It is a conservative investment if you use it in conjunction with stock that you own. When you take the exam, the securities exam, Series 7, it's one of the questions that is going to be on every exam, and it really is a concern. But you've got to understand it. So you look at the option and you figure it out. It's made up of two components: time value and the intrinsic value. If I sold, let's go back to covered calls and stay with that idea. How long would it be before it expires? So if it was 30, 31, 32, 33, the price relates to the length of time. That's number one. Number two, if it's in the money or out of the money. If it was a $10 stock and I sold the $11 February call, is it in the money or out of the money? He says out. A $10 stock trading now, and I own it, and I sold the $11 call. Is it in the money or out of the money now? No, it's out of the money. He's right. Yogi, we made too many wrong mistakes. Well, if you're right 60% of the time, you're going to do fine. If you're right 60% of the time, you're going to do fine. And I'll tell you something, the average fund manager, probably right 60% of the time.